Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Every Monday we like to talk about investing, but at the moment it's hard to talk about investing without thinking commodities. The Ukraine crisis has sent some commodities soaring with record prices early last week before they came back a bit. Vivek Dhar is the Director of Mining and Energy Commodities Research at Commonwealth Bank. Vivek, welcome to Fear and Greed.
No, thank you.
Now, Vivek, I don't know how old you are, but in the years that you have watched commodities, have you ever seen a week like last week?
Certainly, I haven't seen that level of volatility. We've certainly seen prices fall very aggressively for certain supply side events or rise because of those. But across the commodity complex, to see those moves, and in particular for nickel, I'd say as the highlight, it's been absolutely fascinating.
Let's just talk about nickel. So what happened? It spiked 250%. The London Metals Exchange, which is where it's traded primarily, closed or stopped trading nickel as a result. It did come back a bit though. What's going on there?
Sure. So look, with nickel and a number of other commodities are affected by this. It was effectively a physical supply disruption. And in that, I mean concerns that Russian supply would be impeded. Now, Russia accounts for about 6 to 11% of global nickel supply. But when it comes to this kind of high purity class 1 nickel, they're actually much larger, about 17%. So the markets were concerned. So prices started rising. And this is on top of a market that was already very, very tight start to actually begin 2022. So, when the price rose, everyone was like, okay, this is natural. We should expect this. But it actually turned into a financial market event. And that event is a short squeeze. And it's because there was a very large position, a short position, where basically Tsingshan, which is a major stainless steel producer in the world, it had a very large position of nickel that they were going to benefit from if prices fell. Now, as this price crept higher and started picking up, they had to actually cover that position off and buy more and more nickel. And in the end, that led to such upward momentum. We saw nickel go from, it started this year just south of $21,000 a ton, and it rose above $100,000 a ton at the peak of this short squeeze. And then basically, the LME had to do extraordinary intervention, even canceling trades, so that price could come back and the market could settle. And hopefully this week we see the market reopen, but we actually don't know.
Okay, oil, that's the big one for many of us, and many of us who have been around for a while. Well, we've heard stories about the early 1970s and oil shocks and things like that. What's going on in the oil market at the moment, and how does that actually feed through to we as consumers in Australia?
Sure. So in terms of the oil market itself, look, it actually, even before the conflict with Russia and Ukraine, the markets were very, very tight. Global oil stockpiles were at 7-year lows. And more than that, there were some serious questions being asked about OPEC Plus, which is basically a group of countries that control a significant percentage of global supply. They're the ones that the market looks to balance. And that means cutting supply, and that also means adding supply. But their ability to add supply came under some serious questions because they haven't been able to hit their production targets. And when you have both those factors playing out, you have a market that's very vulnerable to a supply shock. And that's exactly what we saw when this conflict with Russia escalated, because Russia accounts for about 10 to 11% of global oil supply. But what is really at risk is around 5% of global supply, because that's what's exported. And once that happened, just the extent of what supply disruption there was, that's what caused the prices to spike. The implication for Australia actually comes through primarily through the fuel prices. And that's because the benchmark, which Australia actually effectively is the fuel price comes from, that is actually what is impacted and translates through. But what we have seen is that fuel price is so linked to what is happening in Russia that we are living and breathing basically any movement in tension, any movement in sanctions, and that's really what we're absorbing here in Australia.
Okay, so we're seeing petrol at well and truly more than $2 a litre, record levels. The consumers in the US are seeing exactly the same thing happening. What we did hear last year is that Joe Biden, the US president, talking about banning imports of Russian oil. But European nations were far less enthusiastic about that, Germany particularly, though the UK did talk about perhaps taking steps down that path. Where I'm leading to is, how do you think this will play out? I mean, if the US does ban oil imports, what happens in the oil market? Just not too difficult a question there, Vivek.
Yeah, no. Look, clearly it's negative, but it's actually important to separate what's rhetoric and what actually leads to an actual supply disruption.
Yeah.
When we talk about what has happened because of this conflict, the sanctioning has been very critical. In particular, the first round of banking and finance sanctions, because that has frozen up a lot of the commodity trade financing. And so you have a lot of commodities stuck, unable to leave Russia because we can't get the financing in order, or we have companies unilaterally doing self-sanctioning where they don't want exposure to Russia.
Yeah.
Now, that has tied up roughly about 70% of Russia's oil exports. So even though the rhetoric is that, oh, wow, we're ratcheting up sanctions, and that's certainly a concern that the financial market takes into account, the physical impact may actually be very muted,
Yep.
right? Because what's frozen already, it may not actually have an impact that US and the UK, because the UK's ban will come at the end of this year. Both of those countries, they're not that dependent on Russian oil as much as Europe. And so it makes sense for them to do it. But will it actually change the status quo in the physical market? I think that's where people have a lot more doubts. But certainly what impact this does have is that it's going to galvanize this approach that we should be looking at banning. And if we do see Europe eventually play that card, it could see oil prices spike even higher. And, we're talking potentially $150 a barrel for Brent. And that, in our view, would lead to, potentially fuel prices here at the retail side going up to potentially $2.40 to $2.45 a litre.
Ouch.
Absolutely.
And something else I've learned about in the last couple of weeks is European gas as opposed to gas. So just explain how European gas, what we talk about there, and why prices in Europe have spiked so much, but not so much in the US and certainly not anywhere near as much in Australia.
Yeah, look, the key linkage is just how dependent Europe is on Russian gas. It accounts for about 40% of their gas needs. And so it's very, very challenging for Europe to find another supply source. And what they've had to rely upon, actually, and this has an impact on Australia, is that they've had to compete away LNG exports that were going to Asia and try and divert that to Europe. And so the spot LNG price, which effectively impacts about a quarter of Australia's LNG exports, that has been forced higher. But for Europe, the pain on the gas side has been very, very significant and already resulted in demand destruction. We've seen, steel mills in Spain, fertilizer companies in Europe, as well as paper mills already close down or cut capacity because those gas prices are so high, it's just economically unviable.
Okay. Stay with me, Vivek. We'll be back in a minute. My guest this morning is Vivek Dhar, mining and energy economist at Commonwealth Bank. Kind of want to move on to the overall impact on the global economy from this, but we saw gold pass $2,000 an ounce last week. That's on the back of the safe haven status. But coal, iron ore, why are those sorts of commodities rising?
Sure. So look, coal is very much linked to exactly the Russian disruption.
Yep.
They account for about 15 to 20% of thermal coal trade and about 10% of coking coal trade. So those markets have certainly been hit hard from the Russian disruption. But when we talk about what we've seen in terms of iron ore, that's a very China-centric story. In fact, it's one of the few commodities which is beholden to China right now. And that's because China accounts for about 70 to 75% of the world's iron ore imports. And so it's very much been driven by short-term policy in China, as well as what we potentially could see in the medium term from China. And right now, it's steel demand hopes. We saw China's 2 sessions happen over the weekend, which is a key policy meeting where they decide economic growth targets for 2022. And what came out of that was, effectively a very strong increase potentially for infrastructure investment. And so that has lifted steel demand hopes on top of the fact that policymakers already had an easing bias from a monetary policy point of view from earlier this year.
Yeah. Okay. So wrapping all of this up somehow, we know how it affects all of us at the petrol bowser, but higher commodity prices generally, what's it mean for global growth and then inflation and potentially how that flows through to interest rates?
Yeah, sure. So look, when we have high commodity prices, certainly the fear right now is translating through to inflation. And that's something happening in a market where inflation was already a concern. So the problem is that this is all additive. We were in a state before but now it's looking like this could play out even worse. And so how exactly will this play out for global inflation is such that we are now worried that growth is going to be impacted, particularly on the energy side. So high energy prices act as almost a tax on consumption. And so that already hurts your global growth potential. But when we also add into that the fact that inflation was already rising, it really puts policymakers in a very difficult position that, we don't want to be in the case where, rates will rise, but we're looking at tempering that. But if global growth falls and inflation is still rising, you're caught in a very difficult position as policymakers. And I think that's where, this word stagflation has come up. And this is a world where we have high unemployment and high inflation. Right now, we're not seeing the unemployment play out anywhere near as that. But that is certainly the market worry and why financial markets are very concerned about this high energy price environment.
Vivek, thank you for talking to Fear and Greed.
Thank you.
That was Vivek Dhar, Director of Mining and Energy Commodities Research at Commonwealth Bank. This is a Fear and Greed daily interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.